Howdy, swings. As predicted in yesterday's video, the markets rose until the S&P 500 hit 5,300, but then fell monotonously. Fear has stifled the market's potential gains, and we're back to levels similar to where we opened yesterday, faster than expected. Does this mean a double dip is coming, or is this just a blip? Let's take a look at Fullhapce's daily swing market forecast. Markets are mostly down. S&P 500, 5,199.53, minus 0.77% down. Dow Jones, 38,763.51, minus 0.60% down. Nasdaq, 16,195.81, minus 1.05% down. Russell 2000, 2050.9, minus 1.05% down. Some sectors performed well today, including insurance, stock exchanges, large banks, energy, consumer staples, security software, casinos, and utilities. On the other hand, some sectors were weaker today, including healthcare, travel and leisure, housing and construction, regional banks, semiconductors, and hardware. Stocks opened strongly on positive comments from a senior Bank of Japan official, but lost momentum as individual company results were released. Q2 earnings reports from major companies such as Airbnb, CVS, Disney, and SMCI were not very promising. In addition, rising oil prices and poor yields from 10-year bond auctions also impacted stock prices. Investors lacked the appetite to buy, so there was no resistance to the steady decline. A senior official from the Bank of Japan has lowered expectations for more immediate tightening of monetary policy, which has positively affected global market sentiment. Investors are hoping for favorable news from upcoming U.S. reports, including the Consumer Price Index, CPI, Federal Open Market Committee, FOMC, minutes, and Fed Chair Powell's speech at Jackson Hole. SMCI's revenue forecast highlights ongoing strong demand for AI-related technology. Shop and Cart both reported strong Q2 results and positive Q3 guidance, while some companies in the apparel, footwear, and fragrance sectors met or exceeded expectations, and the travel industry continues to perform relatively well. Here is our daily market forecast for swings. Fullhapce technical analysis shows that we have reached a moment of choice between a double dip or a rally, which seems to be completely out of the question. The upside potential of the market looks very strong, but the market is technically moving in the direction of a double dip, which confuses analysts. We are leaning slightly in favor of the market moving higher after the unemployment report. The way the market quickly reached the highs we predicted today and then immediately reversed direction to return to yesterday's opening price seems to indicate that the market is waiting for some bullish news. If that is correct, we should see a rally on tomorrow's weekly unemployment report or the earliest good news. But even in this case, it would be wise to hedge against the possibility of a double dip. Here are a few more insights. The overall economic outlook is very unclear right now. Businesses are struggling to balance rising costs with slowing revenue growth. Central banks are likely to make only modest adjustments to interest rates due to ongoing concerns about inflation. Stocks still look expensive, not cheap enough to be viewed as a clear bargain buying opportunity. Here is our devil's advocate. The opposite scenario is that yesterday's market retracement may mean that the market will continue to fall. In this scenario, the market may fall after tomorrow's weekly unemployment report without attempting to rebound for some time. In this case, despite the market's potential, the recovery may be delayed until more positive news comes out. In this case, the upcoming rally may be short and insignificant. The rationale for this scenario is as follows. Many companies are struggling to monetize the AI sector. Consumer spending is slowing in the travel and leisure market. The Fed's June consumer credit report showed a decline in revolving credit balances, and the Manheim Used Car Index rose 2.8% month over month, indicating inflationary pressures. JP Morgan CEO Jamie Dimon expressed doubts that the Fed will be able to bring inflation down to 2%. Geopolitical risks remain high. Here is our conclusion. We might get good news from the weekly unemployment report, which is expected to be released tomorrow, and the market could rise. However, the odds of the market rising or going into a double dip are about the same. It might be wise to wait for the S&P to climb back above 5350 and take that as a sign of a rebound. It's a good idea to manage risk by considering both the main outlook and the opposite scenario. Thank you for watching Fullhapce Intelligence, the best investment partner for swing traders.